Here's a summary of Honeywell's HON Q1 2026 earnings call, designed for easy reading aloud. Honeywell Q1 2026 earnings call summary. Good morning, everyone. Today, we'll be reviewing Honeywell's first quarter 2026 financial results, providing our outlook for the second quarter, and discussing our full-year guidance. Key financial metrics and performance. Honeywell delivered a strong start to 2026, exceeding expectations for both segment margin and adjusted earnings per share. Revenue. Organic sales grew 2%, with notable strength in building automation and aerospace technologies. Pricing and execution remained strong across the portfolio, supported by new product introductions. Profit. Adjusted earnings per share, EPS, came in at $2.45, an 11% increase year-over-year, driven by higher segment profit and a lower share count. Gross margin. Segment margin expanded by an impressive 90 basis points to 23.3%, with margin expansion seen in all four segments. This was primarily driven by pricing discipline, productivity improvements, and accelerated stranded cost removal ahead of the aerospace spin. CEOs, Vimal Kapur, key statements. Honeywell delivered strong results in the first quarter, building on the momentum from 2025, despite a complex geopolitical backdrop and temporary mechanical supply chain constraints in aerospace. We expanded margin 90 basis points to over 23%, driven by pricing discipline, productivity, and accelerated stranded cost removal ahead of the aerospace spin. All of this drove 11% adjusted earnings growth in the quarter, demonstrating the strength and agility of the Honeywell operating system. Vimal highlighted significant progress on the portfolio transformation, with the aerospace spin-off now expected to complete on June 29, marking the final step. He also announced the sale of the Productivity Solutions and Services and Warehouse and Workflow Solutions businesses, expected to close in the second half of 2026. This transformation will result in two leading, pure-play industrial companies, Honeywell Aerospace and Honeywell Automation. Regarding the Middle East conflict, Vimal noted a roughly 0.5% impact on Q1 revenue for Honeywell overall, most notably in process automation and technology. Guidance assumes the conflict persists through the second quarter, resulting in an estimated 1% impact on revenue due to logistics and shipment delays. Despite these headwinds, Vimal expressed confidence in accelerating growth in the second half, supported by a robust backlog. CFOs, Mike Stepniak, key statements. Mike detailed the segment performance, noting that building automation surpassed expectations with 8% organic sales growth, driven by strong demand in data centers and healthcare. Aerospace saw 3% organic sales growth, supported by commercial demand and defense needs, though Q1 results were impacted by temporary supply chain headwinds. Industrial automation grew 1% organically, with strong services demand and performance in warehouse and workflow solutions. Process automation and technology sales were down 6% organically, mainly due to timing delays in catalyst reloads and service upgrades, exacerbated by the Middle East conflict. Mike emphasized that despite near-term volatility, Honeywell is maintaining its full-year organic growth outlook of 3% to 6%. Full-year segment margin guidance is also maintained at 22.7% to 23.1%. Management's forecasts and future outlook. Q2 2026 guidance. Organic sales growth expected at 2% to 4%. Segment margin in the range of 22.2% to 22.5%. Adjusted EPS expected at $2.40 at the midpoint. Full year 2026 outlook. Organic growth outlook maintained at 3% to 6%. Segment margin guidance maintained at 22.7% to 23.1%. Free cash flow guidance remains unchanged. Significant risk factors. Geopolitical uncertainty. The ongoing conflict in the Middle East is a primary concern, impacting logistics, shipments, and revenue, particularly in the process automation and technology segment. Aerospace supply chain constraints. Temporary mechanical supply chain issues in aerospace impacted Q1 output and sales growth, though improvements were seen exiting the quarter. Inflation and costs. While pricing discipline is helping, rising inflation and unfavorable mix in process automation and technology due to timing of high-margin catalyst shipments present headwinds. Highlights: strong Q1 results, exceeded expectations for segment margin and adjusted EPS. Portfolio transformation progress. Aerospace spin-off on track for June 29 completion. Sales of 2 businesses announced. Robust backlog. Orders grew 7% organically, pushing backlog to over $38 billion, with a book-to-bill above 1.1. Aerospace Supplier Framework Agreement. $500 million commitment with the U.S. Department of Defense to increase critical defense technology production. Building automation strength. Continual high single-digit growth driven by new products and demand in data centers and healthcare. Process automation and technology growth drivers. Strong order momentum in LNG, refining, and petrochemicals, with significant project wins. Margin expansion. Broad-based margin improvement across all segments. Lowlights. Process automation and technology sales decline, down 6% organically in Q1, primarily due to timing delays and Middle East conflict impacts. Aerospace supply chain headwinds. Temporary constraints impacted Q1 output and sales growth, though recovery is underway. Q2 margin pressure. Expected sequential margin compression in Q2 due to a less favorable mix of catalyst sales and Middle East impacts. In summary, Honeywell is navigating a complex environment with resilience, driven by its strong operating system and disciplined execution. The company is on the cusp of a significant portfolio transformation, positioning both its future independent companies for success. While near-term headwinds from geopolitical events and supply chain issues persist, the robust backlog and underlying demand across its businesses provide confidence for accelerating growth in the second half of the year. This concludes the summary of Honeywell's Q1 2026 earnings call. Thank you.